here. I want to go to Alan Nuckman, the Bullseye Option Chief Market Strategist. And Alan, we look at events like these, and of course, you're a guy who looks at the markets very closely, where the opportunities are not. This is a non-event for the markets. I'm not saying it's not a non-event for Mr. Trump and what he's going to have to go through as this process unfolds, but for the markets, they're focused on other developments like oil, like OPEC surprising us with a production cut. This is not on their radar, right?
Yeah, barring any surprises, no. We talk price, not policy, not politics, because the thought is most of the times it's already into the price, but we can talk about the stock pop that we've seen in the last month after we've largely been trading sideways for the last 5 months between 3,800 and 4,200 in the S&P. We're starting to reach to that top level once again, so it's going to get very interesting as we come into earnings season, which is what the focus is going to be 2 weeks from now.
You know, we look at this whole drama, the way it's playing out, and there are other Trump cases that are coming out. And you mentioned for now it's not an issue. I'm very poorly paraphrasing what you just said. But I'm wondering with some of these other cases that could build up, does it get to be, if the Republican nomination looks like it's going to be a raucous affair, as if it isn't already, how do the markets respond to that?
Well, the reality is that the volatility of the markets actually numerically is relatively low. We're back here below the 19, we're at the 19 level. So we were double that just a couple of weeks ago when we had some concerns with the banks.
You're talking about the VIX, right? The volatility index, right?
Right. Right, exactly. So that bank kerfuffle ended up being raising the VIX up to nearly 40. We're half of that. So the markets have moved forward. And that's the thing. Markets are always looking forward. All this news that we know about is already factored in. Barring any major surprises, you know, these are topics that we've had a lot of discussions about. So technically, if this market can break out of this range that we've been in for 5 months, we would see the S&P at 4,600, which is another 10 to 15% above where we are now. So I believe in a lot of upside opportunities, the way the market has reacted, and more importantly, how it hasn't reacted. This hasn't shaken anything. And even with the bank issue, it seems to be a very short-term discussion, a short-term problem. And also, we're at the end of the rate hike cycle. That was last year. And, let's look at where we are 1 year after the rate hike started. The S&P is down a whopping not even 10%. So the markets have reacted pretty positively to all these potential issues that could have been a negative impact.
I've been looking at bond yields and all that, and they have done a lot of the Federal Reserve's work. When we talk about influential personalities for the market, Alan, and we're addressing the former president, and what he's going to go through with this arraignment tomorrow, or even the present White House occupant and the reaction he's getting for some of his economic fixes that his critics say has put us in an even bigger fix. But the real attention tends to be on Jerome Powell and the Federal Reserve. I don't know how long that lasts, but I'm wondering, given the fact that market rates over which the Fed has no control have gone down, could you make an argument that that's the market's way of kind of doing the Fed's work?
Right. They've gotten the result that they've wanted. We've got 10-year note yield, which you're keeping an eye on, is below the 3.5% level. So historically, we've talked about how low that really is. And if you look at the futures markets, you're seeing the futures markets for 2024, rates get down to 3% and so forth, when you go further out. So that's the market. Those are the markets that the Fed can control. The 10-year note yield is driven by supply and demand, and that's showing a lot of stability. So if we really sum everything up, it's real simple. The markets that are down are the dollar, rates, inflation, and those are positives for stocks. The markets are up are everything. Everything is up in 2023. There's not really any marketplace, even now with crude oil back at the 80 level. Crude oil's been trading between 70 and 90 for 9 months. So we're just in the middle of the range of crude oil, but it's still 40% off the highs from last year. So again, that's what the Fed wanted to accomplish. They wanted rates to stabilize. They wanted prices to come down. And we've seen inflation come down and a lot of positives. Let's see if we can see that that follow through in the stock market, and that's the next move I'm looking for.
Alan, always great talking to you, my friend. Sorry for the slight audio delay. We had Alan Nuckman, the Bullseye Option Chief Market Strategist.
Thank you.
He was very optimistic on stocks in the middle of that down world we were having, even talking about the so-called contagion with banks. He had not seen evidence of that. Meanwhile, on your